Amara Raja sees a sharp margin improvement in the second quarter. The battery maker says demand remains robust across categories. Also announces the setting up of a lithium-ion battery manufacturing subsidiary.
And it's a weak quarter for Ajanta Pharma's high raw material costs, freight costs, as well as price erosion in US generics result in a 900 basis points hit on the company's margins.
Siaram Silk reports a strong quarter in the second quarter. We have revenue surging to 32% while profit growing 50%. The stock surges nearly 15% in trade.
IEX October updates indicates a 13% year-on-year drop in volumes, a high base and reduced renewable energy certificates. That's what's contributed to the decline.
SKF surges after a strong show in the second quarter as the margin grows and profit surges, while luxury watchmaker Ethos too rallies after record EBITDA, profit and revenue numbers for the quarterly numbers. The management will join in to discuss the numbers later on the show.
Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me as always is Mangala Malu. Mangala, we need to pull through a few hours before we head off into the weekend. But before that, we have a couple of managements as well who are joining in on the show. Elecon Engineering, they delivered a solid set of numbers in the second quarter. The profitability as well did jump up by more than 80%. Earnings were largely aided by growth across segments. To break down the numbers for us and tell us what it means for business going forward, well, we're joined by the Chairman and MD of the company, Mr. Patel. Hi, Mr. Patel. Good morning and thanks so much for joining in. Well, you're walking the talk. You've given us some guidance for the year, and it appears, at least as things stand, you're on course to achieve it. Given that you have such a good first half of the year, do you want to revise the guidance? I mean, is there an upside risk to that revenue guidance that you've given?
No, we will continue with our targets as we see that we are going towards it very comfortably. But we would like to make sure that we have solid next year also.
So 1,500 crores for this year is a given?
Yes.
And 2,000 crores for next year, right?
Yes.
All right, we take that point. Mr. Patel, I'm just looking at your order intake as well. For the first half of this year, it's been a total of around 838 crores, about 100 crores in your material handling business, looking at 750 crores in your gears business as well. What kind of order inflow do you expect in the second half of this year? And I ask this particularly because a large part of your, geographies, export geographies, are facing some sort of economic issues.
Yes, the foreign entities, because of the high energy cost abroad, are facing some challenges. However, the inquiries on hand are quite high, and therefore we are hopeful that we will be able to increase our order inflow even from the foreign entities. So apart from that, there is a robust order inflow on hand from the domestic market, and we see that there is a good possibility that we will be able to reach our next year's target very comfortably.
So could you give us a sense of what kind of order inflow are you expecting in the second half of this year? It's about 850 crores in the first half. And if you could split that up between your gears and material handling business.
Material handling was about 94 crores and there was 744 crores. We have at present pending orders of 714 crores. And we expect a similar kind of situation by the end of the year.
Okay, so, but what is the order inflow target for the year, sir? That's what you're trying to get at.
The order inflow target for the end of the year would be about 750 crores.
So from 700 crores, 750 crores more order inflows in the second half of the year. Are we getting that correct? Okay, got that. Another point that I'm noticing in your presentation is, Mr. Patel, is the business from Navy. I think that's a growth driver for you. That's offers a lot of potential. Could you tell us currently how much of your revenues come in from the Navy, and going ahead, do you see a huge scope for that to increase?
Navy goes through projects, which means that they come and go, and in between there are quite often gaps.
Okay.
Therefore, it is very difficult to ascertain what it would be. However, what we have realized now is because the government is spending large sums of money on defense sector, we believe that there are a large number of projects which would be announced very shortly.
Okay.
And we are hopeful that a sizable part of them would come out.
Okay. Would you give us a number of how big that opportunity could be for you in particular?
It would be difficult to say, but I would presume about 200, 300 crores annually should be the potential going forward.
All right, we take that point. And in your material handling business, I remember you saying that, you're targeting about 200 crores coming in from that business annually, and that can actually go all the way up to 300 to 400 crores. Can you give us a sense of where that number is likely to stabilize?
We are planning that we would also diversify into other areas in future years to come. However, right now we see that the potential would be close to 400 to 500 crores.
By when do you get to that mark, sir?
In about 2 years.
In 2 years. So by FY 25, we'll say that this material handling business that's currently going at a run rate of around 55 crores odd, it'll start doing a run rate of close to around 100 crores per quarter. Are we getting that correct?
Yes.
Okay.
You're absolutely right.
All right, fair number. The fact that you're guiding for such large numbers, Mr. Patel, there could be some capex as well that you'll have to incur, right? I think you're virtually debt-free as of now, and you've given that you're going to be debt-free, I think, in the next couple of quarters. Now there's a small debt, I think, that's there in your books. What is the capex spends? Break it up for us, and what could be the asset turn on those capex spends?
This year we are spending about 100 crores. This is entirely from our earnings. So there is no borrowed funds for this.
Okay.
And going forward, we would be only requiring some kind of bridging equipment, which would not exceed approximately 100 to 150 crores on an annualized basis. We have spent this year 100 crores, out of which a sizable amount has been invested for putting up solar plant for generating our own electricity.
Right. You've given us a standalone revenue target of 1,200 crores this year. 1,500 crores comes in from consolidated business. You've given us a standalone margin target for this year at 24%. But you haven't given us a consolidated margin target. I mean, I just wanted to understand, because overseas business, may also get an impact because of the currency, etc.
I would say the consolidated EBITDA margin would be around 22%.
22%. All right, Mr. Patel, you briefly mentioned about some solar plant that you had spent some money on, and that will give some savings, I'm guessing. If yes, could you quantify that amount?
Approximately 15% would be the saving overall. 70% of our electricity generation would be coming in from renewable energies.
70%, 70.
Yes, 70.
And
because we also have windmills, which we have installed some time ago.
All right, we take that point. And where do material handling margins stabilize at the 500 crore mark that you're talking about? Because that has been a bit of a drag on your overall margins as well, right?
Yes. We believe that an EBITDA of 14 to 15% is where it would stabilize at.
Okay. All right. Thanks a lot for joining in, Mr. Patel, and giving us the outlook on the business. That is Elecon Engineering, maintaining their 1,500 crore revenue guidance for this year, giving a 22% consolidated margin guidance for this year as well, and believes that Navy business could be almost 200 to 300 crores in terms of annual revenue going forward for them. With that, we'll step into a short break. Actually, before we do that, let's also take note of a few ideas for profit coming in from our colleagues at Money Control Pro. Nitin Sharma joins in with a stock.
MapMy India's second quarter revenue saw strong growth driven by the G-Trophy and the better than expected show by Consumer Tech and Mobility division. On console basis, G-Trophy contributed around 12% of the revenue, but at the cost of margins as device sales eroded 750 bips from the EBITDA margin. Other than this, company has started ramping up on the marketing spend, which stood at 5% of the revenue and likely to be around it in the near term. G-drop is expected to impact the margin for up to 2 years, but will also help the company maintain its high revenue growth and later add on to the profits via SaaS offerings. MapMyIndia managed to sign on a large four-wheeler EV OEM this quarter. Despite margin slippage, we estimate that the EBITDA margin for this year should be around 44% and then expand to 46-47% FY24 while still maintaining a 30-35% revenue CAGR. High margin and strong return ratio along with the growth trajectory gives us confidence that the FY24 P of 45 times stock is still a good investment bet in the Indian tech space, and any correction in the stock is an opportunity to build position in this stock. We recommend investors to buy this stock.
All right, thanks a lot for that, Nitin. For the time being, we'll slip into a short break. But up next, we'll get chatting with the luxury watch retailer, Ethos. The management will be joining us to detail their numbers.
Welcome back. Let's get in another management. Luxury watch retailer Ethos is buzzing in trade today after a strong quarter. The company has reported its highest ever EBITDA revenue as well as profit numbers for a quarter. Yashovardhan Sabu, who's the founder and chairman of the company, joins us now. Thanks a lot, Mr. Sabu. Always a pleasure speaking with you. And it's been a good first half of this year, almost 57% in terms of revenue growth. Absolute numbers as well as have been strong. The important part is that the second half of this year, which includes the third quarter, which is the biggest one for you, is still upon us and it's still underway. You had earlier given us a guidance of 30 to 35% in terms of annual revenue growth. Wanted to know that, after you've seen a significant part of the festive season, do you want to up your guidance? I mean, how was the third quarter and what are you confident of ending this year with now?
I have to be careful not to get very excited.
Yeah.
We're very happy with the results. They're better than what we expected. Despite the fact that globally there are some headwinds in the business, but Indian market still remains very, very strong. We're seeing a very good third quarter go ahead. So, but we might get some delays in the opening of new stores, which were happened in the last, in quarter two. So I'm still very, very confident of keeping our earlier guidance, which is 30 to 35% growth.
Okay, all right. Hi, Mr. Sabu. This is Nigel now. Could you tell us exclusive brands as a percentage of sales? What was it? I think it was around 25-26%. If you could give us a sense out there. And the last time you told us about pre-owned sales, that could hit around 75 crores. You want to stick to that number, or is there upside there?
Let me talk about exclusive brands. So exclusive brand sales has gone up now to about 28-29% in the last quarter. Sometimes it just varies a little bit depending on the availability of products. In the last 2 years, there's generally been a shortage of products across various brands. That now easing out. But we expect the percentage of business in exclusive brands to continue to grow. And we expect it to reach about 35 to 38% over the next couple of years. So that's a happy story. We're seeing growth along expected lines. Okay. There are more exclusive brands that are under discussion, and that portfolio should be expanding in the months and quarters to come. As far as the business of pre-owned watches is concerned, I don't think there's going to be a growth above 75 crores. There are two reasons. I think worldwide, there has been a slowing down in the business of pre-owned watches. A lot of it was fueled in the US and countries that were going very well. There has been a slowdown. So in India, the market still remains good. There is our big bottleneck is still the availability of watchmakers to refurbish the watches, and we don't sell any watches without proper refurbishment. These are very special skills. We've been hiring watchmakers. We've been sending them, some of them as we speak now, they are out in Switzerland getting specialized training. But this growth in this capacity is going to take time. So I think growth is going to be steady, but it's not going to be like meteoric.
Right. Mr. Sabu, I'm going back to my first question with regards to your annual revenue, and that's primarily because last year you did 577 crores. If you do about 35% as you're guiding this year, it would be around 780 odd crores. The first half of this year itself, you've done 350 crores. And usually the second half, you do a good 30 to 40% more than the first half. So, I mean, if I just look at it numerically, you should easily cross around 800 to 850 crores in terms of revenues this year, right?
Well, it's not 40% more. You know, historically, the first two quarters, they account for about 44 to 45% of our annual sales. But again, there are variations there, depending on exactly when the wedding season starts and so on, whether it's, when Shraddha ends and so on. So, and we do expect a certain softening in the final quarter of the year. We are still a little conservative. But despite that, we are pretty much confident of this 30 to 35% guidance that we are giving.
Right. And did you close two stores during the quarter? I mean, because I looked at your previous presentation, it said you have 50 stores, and the current presentation says 48 stores, while you were looking to open about 8 to 9 stores this year. How many have you opened so far? Can you give us a sense? Because you said there was some delay in store opening.
Yeah, unfortunately, we haven't opened any stores in this year. There were supposed to be a few opening, specifically Indore was supposed to, 2 stores in Indore were supposed to open. And many of the mall openings, these are all new mall stores, they've been delayed for some reason or the other. And we're sort of helpless in that. But we still are gunning for about 9 stores opening in the final quarter of the year. Sorry, 1 of them will open in the current quarter and about 8 in the final quarter of the year. So we're not going to see their contribution to revenue this year, but it certainly gives us a big boost for the following year. Apart from that, we are actually upping a lot of our growth. So the number of stores that we're going to be opening next year is going to be much higher than what we had planned at the time of the prospectus and the IPO. So we intend to accelerate growth going forward.
All right. You're talking about the product mix changing towards the premium category. I think the average sales price was around 1.53 odd, if I remember correctly, per unit. Where do you see that number headed? What's the outlook out there?
Yeah, it was about 1.53. 4 years ago, it was exactly half.
Oh.
So it has evolved very, 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 very steadily. We still expect it to go up. However, not as steeply as it has gone in the past. A lot of the reason for the past has been that we have decreased our presence in the markets above or the price point below 30,000 rupees and increased it in the price point above 3 lakhs and 5 lakhs. While that trend will still continue and the growth will be pretty high, but it's not going to be as high as before. We expect it to get to about 1.8 to 2 lakhs in the next 18 to 24 months.
All right, 1.8 to 2 lakhs in the next 18 to 24 months. And by you removing yourself from the sub 30,000 place, you have you've alienated both Nigel and me out here, Mr. Sabu, because I don't think
we have got eliminated, sir, from your target audience. Unfortunately,
no, I would love to introduce you to some of the watches which are not only great to wear but are also they hold value.
Right.
They are investments to make.
Okay, I can tell you one thing, Mr. Sabu. While we might not be as interested in the watch business and the high-ticket items out there, you have non-watch business as well. You have, the luxury baggages and you have the luxury jewelry, etc., which is just seeding right now. Just wanted to understand how big can that be, say, in FY24 and thereafter?
So let me talk. The luxury business is extremely interesting, but I don't think it's going to be very large in terms of size. The brand that we signed on, Rimowa, is the world's top brand for luggage. And we're very glad, and I think it's going to be growing steadily. However, we're not going to see it move the needle for the company in 24, but by 25, 26, it will start to have an impact. The other business, which is jewelry, and we've signed on Messica Paris. We haven't started the business. We've just got in the first goods. Now we will see it going on.
Okay.
I'm a strong believer in the growth of the branded jewelry business in India. And we will be investing more and more in that field. And over the next 3 to 4 years, it's going to become a strong pillar for future growth.
How much will you invest, sir?
No, we haven't really put numbers to it. I'm saying investment in terms of effort and time.
Okay.
And whatever the money is needed. We need to learn this business and the international branded jewelry business.
Yeah.
It's on a start, but it's going to pick up speed just the way luxury watches did about 10 or 12 years ago.
Okay, all right.
We're on that threshold.
Okay.
Nigel, speaking about effort and time, when you have a 3 lakh plus rupee watch, you have made all the efforts in your life, and you are probably having a lot of time on your hands as well. Expensive time, so to say.
I've got a long, long way to go, Mr. Sabu. But thanks so much for joining in, giving us clarity about your vision going ahead. For the time being, the street likes what you're saying. The street has liked the numbers. The crucial part is, how will the second half of the year pan out? Thanks so much for stopping by.
Right.
Well, on that note, though, we'll slip in a short break. You come back, we'll update you on how the markets are faring. Well, the markets are moving a little bit lower towards that 18,000 odd mark. Nothing really to worry after the kind of resilient performance that we saw yesterday. But a couple of stocks deserve special mention. HPCL now is at the low point of the day. Bosch as well is getting a bit of a knock. And Laurus Labs as well has taken a hard knock actually in the last few minutes. So it's moved lower. On the flip side, one of the biggest underperformers in this week has been Intellect Design. The numbers very disappointing. The street didn't like it one bit. That one is seeing a bit of a bounce from the lows of the day. It's up close to around 4% or thereabouts. But that's it from Mangalam and me on this edition of Chartbusters. You stay with us. Trading Hour comes up next.